Baik, saya akan teruskan dengan perbincangan dalam bahasa Inggeris, di mana the government's latest revision to the Sales and Service Tax or SST has sent ripples through the property and finance sectors. With new services now taxable under the revised regime, real estate investment trusts, REIT and financial service providers are bracing for increased operational costs, tighter margins and strategic shifts. So what does this mean for investors, businesses and even everyday consumers? Joining us now is Eng Sulin, the head of indirect tax at KPMG in Malaysia, to help unpack the implications of this SST shake-up. Good morning, Sulin.
Good morning. Thank you for having me here.
No problem. All right, firstly, we could start with by sharing which specific elements of the new SST revision that actually are expected to hit rates and financial services the hardest, and why are these sectors particularly vulnerable?
Yes. For REITs, the potential expanded taxable services that are applicable are the rental and leasing services, as well as, to a certain extent, construction services. The service tax at 8% on rental and leasing will be levied on commercial properties. However, the government take note of it, and there are exemptions available, particularly for the micro, small and medium tenants, those with annual revenue below 500,000 ringgit. And also, there are non-waiver contract transitional rules. Hence, to a certain extent, REITs should try and see if they can avail to these exemptions to help their tenants whilst remain competitive. Construction services is another taxable service at 6%, but it is there any construction or renovation work to the commercial buildings, they will hit their costs. So for REITs, these are the potential implications, but there are measures, there are exemptions available to cushion it. Whereas for financial services, previously most fees and commission income were not subject to service tax, except for certain advisory type of services, especially in the investment banking space. But with the expansion, these are now subject to 8%. However, the positive side of it is that these are basic banking services relating to the operation of savings account, current account, or similar, is still not subject to service tax, as well as interest or profits. Hence, there are exemptions and exclusions available to take advantage of and cushion the impact.
But Sulin, for rates specifically, how will the taxation of previously exempt services like property management affect returns for investors and also future property development plans?
Okay, for property management, it was actually already subject to service tax earlier. At a rate of 8%, it does represent a cost, and if passed on to the tenants, could in turn affect rental demand or profitability for the REITs. But it is hoped that the amount is not significant enough to deter occupants. I believe when it was initially implemented, there was an initial knee-jerk reaction as tenants try to negotiate better pricing, but it should normalize eventually. For future property developments, this will be an additional factor amongst the many other factors to be considered when undertaking future projects and negotiating contracts, especially long-term contracts.
Do you foresee REITs restructuring operations or outsourcing services to actually reduce their SST exposure, and what risk come with that?
In the short to medium term, REITs will try to explore available exemptions such as the business-to-business exemptions and group relief, particularly where they have many related companies in the group, and they need to see how they can enjoy these exemptions, which comes with conditions. Outsourcing of services may be one of the methods if they are not able to enjoy the group relief exemptions, but care must be taken to ensure there is no tax cascading or other tax considerations.
But turning to financial services, Sulin, with more advisory and also fund management services that is now taxable, will the increased cost be passed on to consumers?
On this, I think it depends on the financial institution and their product, their business arrangement with the consumers. I believe it is a demand and supply consideration as well as how their competitors react. It will be a balance. The financial institutions have been operating in this space for many years, and I believe have many experiences in navigating this.
But given these sector-specific stresses, is this a latest SST move a sign that Malaysia should reconsider transitioning back to a broader-based GS system, for example?
I wouldn't call these stresses. I would say that this is a different type of tax mechanism because GST is also a tax, just that the mechanism is slightly different. I would say that this expansion appears to be more carefully thought through and a more targeted approach in an effort to make the tax structure more progressive, broadening the tax base whilst ensuring that the right yard is not unduly burdened. I believe the government has commented previously that it is not the right time to reintroduce GST given the fiscal position of the nation. Hence, in the interim, expanding the scope of sales tax and service tax on a targeted basis can help improve revenue collection, whilst ensuring it does not impact the man on the street too much. On GST, I think we will have to wait and see.
Sulin, we have about 5 minutes or more. I may add whether could the SST revision potentially lead to a capital flight or reduction in foreign investor, for example, when it comes to participation in Malaysian REITs and also, or perhaps capital markets. What do you think about that?
I don't think that maybe in the interim or in the initial knee-jerk reaction or initial reaction, businesses will try to see whether they want to do investments overseas, they want to try to move their operations overseas. But I think after you need to do feasibility studies, you need to see there are pros and cons, so you need to weigh the benefits of doing businesses in Malaysia versus overseas, particularly for REITs businesses, and then see ultimately whether the local environment will still be supportive. I think the intention of the government is for this expanded service tax and sales tax scope is very targeted. It's still to protect the right yard. So hopefully businesses can take advantage of all the various exemptions given to still be able to do business competitively.
In your opinion, what's the risk of disintermediation or innovation bypassing traditional financial services due to higher SST burden, for instance, perhaps via final technology or fintech, or perhaps offshore alternatives?
In terms of technology, I think there are exemptions available. Just to be clear, there are exemptions available to encourage businesses to undertake technology and automation. So perhaps in line with SST, then there is also the e-invoicing to help cushion the impact of this expanded scope. Because with e-invoicing, it will also help to make all the invoices, the charges all more open, more transparent, and hopefully it will help businesses to understand where the taxes are, help the right yard to understand where the taxes are collected, and ultimately to benefit both the government as well as the development of the country.
But could this SST revision actually trigger REITs to restructure their service models or operations to mitigate this tax burden, and perhaps, for example, outsourcing by relocating sourcing service functions as well?
Like I mentioned earlier, the initial reaction may be to find other ways to restructure, to find other ways to see whether the cost can be absorbed elsewhere, can be passed elsewhere. But apart from trying to see whether it can be passed elsewhere, there is, like I mentioned, the government also take note and has given a lot of exemptions, a lot of incentives available to the businesses to cushion the impact. So I guess not only to restructure, to look at how do you want to set it up, but also to see whether any incentives, exemptions can be enjoyed. Because for players, if you don't try to enjoy these exemptions, incentives that are readily available, then your competitors may do so. So you want to make sure that you are also enjoying it to remain a level playing field.
But could this new relieved SST revisions actually trigger lobbying efforts from affected sectors for exemptions or relief? And what lessons can Malaysia learn from other countries that transition back to a GST after SST-like systems?
In terms of what experiences, I guess it is more communication, awareness, more the interaction, more transparent discussions with the government, with the authorities, and businesses should also take note that should also know the intention of these taxes. And I think what the businesses and the rakyat want to know is how the taxes collected could benefit the country and ultimately to the nation.
Maybe perhaps last one before we could wrap up this discussion, how might SST revisions influence Malaysia's broader economic competitiveness and also investment climate as a whole?
With this expanded scope, again, I want to say it's very targeted. It's targeted towards certain sectors. I think the government has already undertaken a lot of analysis to see what sectors to target and implement this SST. So hopefully the impact would not be huge. Maybe in the interim, there will be reaction to say maybe for the cost of goods, cost of services, there will be initial reaction, but ultimately, hopefully it will just taper it out, it will neutralize and businesses will accept it.